Alright guys, so I hope you're doing fine as always. In today's video we will have a look at when to adjust your trading strategy and when not to adjust your trading strategy. So most traders think their strategy is the problem, so they change it. Then they lose again and they change their strategy again and again and again. Before they know it, they've tested 10 different strategies in 3 months, for example, and none of them works. But the real problem usually isn't the strategy, it's when traders decide to adjust it. In this video, we will go over when you should not change your trading strategy and when you could or should, and how to avoid the trap of analysis paralysis. So most traders fall into one of the two extremes. The first group is the strategy hoppers. These are the people that take 3 losing trades, for example, and immediately think something is wrong with my system. So they tweak it, they start adjusting their strategy, etc. They start changing the indicator, they adjust their time frames, they add on another confirmation, for example, and suddenly the strategy becomes something completely different than the original strategy they used, so they lost their original edge. You just have to understand that even the best strategies in the world have losing streaks. Losses are part of the statistical distribution, not necessarily proof that the strategy is broken. So just because you're in a losing streak really doesn't mean your strategy isn't working. We all have losing streaks, it's part of the game. It's the probability, it's just a number game. It will always happen to the best of us. The second group is the stubborn traders. These traders do the opposite. They stick to the same strategy no matter what, even when the market has clearly changed. I did include this quote here on the screen. The definition of insanity is doing the same thing over and over and expecting different results. I'm a really big fan of this quote. It fits trading really well. Here are some examples of stubborn traders. For example, they use a trend-following system in a completely sideways market. Or they use a range strategy during a strong breakout phase, for example. Just know that markets evolve, so the skill isn't blindly sticking to a strategy. The real skill is knowing when adaptation is actually justified. Now, when should you not adjust your strategy? It's important to understand this because this is where most traders go wrong. So don't adjust your strategy after a few losing trades. 3 or 4 losses mean nothing. Even with a strategy that has a win rate of 60%, you can easily have 5 or 6 losses in a row. This is just normal probability. This is just a simple numbers game. If you adjust your system every time this happens, you will never actually test the edge. Don't change after a bad day or week. Short-term performances are mostly noise. One bad day in crypto or indices doesn't mean your strategy stopped working. Professional traders evaluate performance over a large sample size, not over emotional moments. So, just because you have a bad day or a bad week doesn't mean your strategy isn't working. I know it's difficult to accept that, but we all have bad days, we all have bad weeks. That's just part of the trading game. And don't change your strategy because of outside opinions. This happens all the times, especially to beginning traders. You see someone on social media saying, For example, the RSI doesn't work anymore. And you've been using this RSI for a few weeks now, and you just stop using it because some influencer said on social media it doesn't work anymore. Or you often hear people say that trend trading is dead, or reversal trades are impossible. And all of a sudden you start doubting your entire system just because some influencer with a big following said this online. Your trading plan should always be based on data and not on opinions. That also includes my opinion. You shouldn't base your strategy based off what I say. You should really be looking at what works for you and test this out. Like I always say, what works for me might not work for you, and what works for you might not work for me. Everyone is different. Now it's also important to know when you should consider adjusting your strategy. There are, in my opinion, 3 valid reasons. First, we see a market structure change. Like we all know, a market moves through phases. For example, you have trending markets, you have ranging markets, high volatility, low volatility periods. In this case, a breakout strategy might thrive during strong trends, but it might struggle during sideways chop. If the market environment changes, you may need to adjust your execution, not necessarily replace the entire system. I think most of you already saw this in the Discord server. I currently changed to mainly shorting shitcoins, because the big strong coins like Bitcoin, Ethereum, etc. are hard to predict. The order book is very low. We see big candles which can totally screw up a DA. So it's really hard to read these strong coins for me at the moment. So I mainly switched/adapted to a more volatile trading strategy, you could call it, which includes shorting shitcoins or smaller coins, if you don't want to call it shitcoins, that had a very strong manipulative move up, and I try and catch the short based on vector candle recoveries and stopping volume candles. A lot of the times these trades are taken with market orders. If you compare that to how I traded like half a year ago, for example, back then I traded most of the strong coins with always clean limit orders, etc. But in this current market structure, I had to adapt to going back to shorting all these small coins that had much volatility, so I can try and catch a reversal. Another valid reason to adjust is when your edge disappears statistically. This is why tracking your trades is so critical. If after, let's say, 25 to 50 trades your results show your win rate is collapsing, your risk to reward is shrinking, and your expectancy is turning negative, then maybe you need to start looking for some adjustments. But keep in mind, this is after some solid data, after quite a big sample size, so not after 3 or 4 trades, of course. So if that happens, then it's time to investigate. But again, the keyword here is sample size. If your sample size is not big enough, you're just reacting off emotions and not the numbers themselves. And finally, when there's a structural market shift. Sometimes markets genuinely change. For example, crypto has very much volatility cycles. You have micro-driven index markets, or you have liquidity shifts. These structural changes can affect how strategies perform. But again, this should be based on data over time and not short-term reactions. Now, how do we avoid overthinking? Here is a simple process you can follow, defined 4 steps. Step 1 is define your strategy clearly. This includes your entry rules, your exit rules, your risk management. No, you don't need to make a checklist of I need this, this, this and this to have an entry, but you can have a list of possible confirmations that you see on the chart that can lead to an entry. But if your strategy isn't clearly defined, you cannot evaluate it properly. And yes, over time this becomes a bit more loose and you go a bit more of gut feeling, but especially in the beginning it's very good to clearly define your strategy. Step 2 is track every trade. Keep a journal. This turns trading from guessing into data analysis. Yes, I know I personally don't do this anymore, but I definitely did in the beginning or when I test new strategies. In your journal you should log your setup, the outcome and the market condition as well. I think it's important to mention, are we in a trending market, were we in a ranging market, etc. Step 3 is review in batches. Instead of reviewing after every single trade, review after, let's say, 10 to 30 trades. This prevents emotional decisions and gives you a statistical significance. Because if you lose a single trade, this can just be bad luck. A losing trade doesn't mean it's a bad setup. But in the moment you're emotional, you might not feel that way and you start looking for things that are not there. You're starting to look for reasons of why it went wrong, while there might not be any at all. You start doubting yourself just because you had one single losing trade. If you review this in batches of, let's say, 10 to 30 trades, these emotions are much smaller. You become a lot more rational. Finally, step 4 is adjust only one variable at a time. If something needs improving, change only one thing at a time. This can be your entry timing, for example, or a stop loss placement, or your risk size even. If you change everything at once, you will never know what actually improved the system. I know I only wrote down like entry, stop and risk, which are very generic, but this can also be based on your strategy. For example, change your RSI to a MACD, or remove the MACD from your analysis, or look at your RSI on a different time frame, for example. But only change one thing at a time and not just the whole strategy from scratch. So to summarize, the goal of trading isn't to constantly optimize your strategy. The goal is to execute a good system consistently. Most traders fail because they are either constantly changing strategy or refusing to adapt at all. The real edge is in the middle. It's building a system, test it properly, review it with data, and only adjust when the evidence actually supports it. That's how you avoid analysis paralysis and start trading like a professional. To go a little bit deeper on this is you don't need to see every single confluence on the chart, because most of the time it won't be there. It's a matter of being happy with your entry. It's a matter of being confident, trading based off only 2 or 3 confluences instead of 5 or 6, for example, in a rough market. Yes, you will lose trades. You might lose more trades than you did before because a market has changed, but that's normal. The markets will keep on changing, and maybe the next cycle fits your strategy better, or you find a better adaptation to that cycle. Every single trader has different strengths and weaknesses, so if sometimes you feel like this market is against you, Don't worry, we all have this. It's part of the game. Just remember the next cycle or the next shift might suit you better. And don't instantly change strategy. Test different things, only change one thing at a time. Test in batches, not base it off 1 or 2 trades. You can have losing streaks of 5 to 6 trades even if your win rate is 60%. It's normal, it's just statistics, part of the game. It's the reason many people quit. Don't be that guy that quits because you have one losing streak. Sadly, it's something we all go through. You're not alone in that. So keep your head up high and you got this. So that was everything to this video in a nutshell. If I forgot anything or if there are any questions, please feel free to ask it in the comment section or on the Discord server. And I will catch you guys in the next one. Take care. See ya. Bye bye.